Hi, everyone, and welcome. I know climate change and accounting might sound like an odd mix, but stick with me. This is where accounting gets future ready. Today, we are talking about the Australian Accounting Standards Board Sustainability Standard 2, the new climate reporting rule for companies. In simple language, if climate change affects your business, it should show up in your financial disclosure. This isn't just about emissions, it's about risk, cash flow, and reputation. And here's the kicker: accountants are at the center of this shift. Companies need guidance, investors want transparency, and professionals who understand this now will lead tomorrow's conversations. This is more than compliance, it's a chance to grow your career and stay ahead of the curve. You don't need to be a climate expert. You just need your accounting mindset and curiosity. So let's break it down: clear, simple, and even a bit fun.
So, what are we going to cover in this course? We'll begin by unpacking why climate related financial disclosures matter right now. What's changing? What is the new disclosure standards related to sustainability? And why are accountant and finance team at the center of this shift? We will explore the four pillars of AASB S2, that is, governance, strategy, risk management, and matrix and targets. These are more than reporting categories. These are tools for leadership. We will bring each to life with real examples for companies navigating these changes today. Then we will break down emission scopes, that is scope 1, scope 2, scope 3, into simple terms, relatable terms. You will understand what each of the scope means and what are the challenges to gather data around scope 1, 2, and 3. You will also learn to identify and integrate climate risk like bushfire, carbon taxes, or changing customer expectations into your existing risk and financial processes. This is where sustainability meet enterprise risk management and post strategy. We will dig into the matrix that matters, from emissions and water use to financed emission and green capital deployment. We will not only explain them, but also show you how to calculate and apply them in real life scenarios. After that, we'll walk through scenario analysis, that is, how to stress test your strategy under different climate futures, from best case of 1.5 degrees to the extreme pathways. So, this course is just not theory, it's strategic planning tool every organization should be using. At the end, we will tie it all together with two case studies so that we can look at how sustainability standard looks in action for different companies, in this case, an operating company and a financial institution. Finally, we'll end with practical steps for you to get started. You will have a clear understanding of the requirement of the standard and how to clear an action plan which you can use in your organization. Let me remind you, this course is not about compliance. It's about building credibility, resilience, and long-term value. So let's get started. Why do climate-related disclosures matter for your job? ASBS2 is Australia's new standard that helps business explain how climate risk, like flood, fires, and rising energy costs, could impact their financials. It aligns with international guidance, so what you report here makes sense to the global investors and lenders. Here's what this means in practice. Let's say your company is applying for a loan. In the past, the bank may have looked at your cash flow and assets. Now, they also want to see how exposed you are to climate risk. If you rely heavily on fossil fuels or operate in a flood-prone areas and you are not tracking or disclosing that, they might consider you a high-risk borrower and offer a higher interest rate. On the other hand, companies that invest in solar, track emissions, and disclose risk clearly are seen as more responsible and future ready. They often get better financing terms and attract more investors. So, How does this apply to you? If you are in finance or accounting, you're already dealing with numbers, energy bills, fuel cost, capital plans. That's where climate data starts. You don't need to be an environmental expert. You just need to ask, where could climate risk show up in our financials and start connecting the dot? Think of AASB S2 as your guide to make those risks visible so that they could be managed, reported, and used to build trust. Because in today's world, if your company stays silent on climate, the market assumes the worst. And if you're transparent, proactive, you turn risk into opportunity. When we talk about the Australia's climate reporting standard, we often focus on rules and data, but underneath it all, there are four key building blocks every company must understand: governance, strategy, risk management, and matrix and targets. Let's break each of them down with real life examples. First, governance. This is about leadership and accountability. It asks, who is responsible for climate risk in your company? As an example, ANZ provides a powerful message. They have tied executive bonuses to emission reduction goals. That sends a message from the top. Climate action matters. The takeaway? When leadership incentives are aligned with climate outcomes, the entire culture of the organization shifts. Second, strategy. This is where climate risk becomes part of the business planning. Patagonia, for instance, redesigned their supply chain to avoid regions which are vulnerable to extreme weather. They are not just responding, they are planning ahead. It shows that managing climate risk well isn't just about survival, it can be a competitive advantage. Third, risk management. Climate risk now sits alongside financial, legal, and operational risk. Qantas, for example, includes climate disruption like heat waves and storms in their flight planning and cost forecast. This proves a crucial point. Risk is no longer just financial, it's environmental. It needs to be built into an enterprise wide risk system. Finally, matrix and target. You can't manage what you don't measure. Companies must disclose emissions, scope 1, scope 2, and scope 3, and track performance against the climate goals set by the company. Eco Retail is a great example. They cut their scope 2 emissions by 30% with solar and saved $500,000 a year. That's how measurement leads to real life saving and better decisions. Together, these four building blocks help companies not just comply with standard, but lead with transparency, resilience, and impact. So, as a finance or accounting professional, ask yourself, are these four areas reflected in your reporting, your risk system, and your boardroom conversations? If you're in finance and accounting, you might be wondering, how do I actually apply these reporting concepts in my work? Let's start with governance. What are the simplest steps to include would be to include climate matrix in your monthly or quarterly reporting pack. This could mean adding important emissions matrix in your reporting packs or flagging progress on key energy saving initiatives. If you're working in finance team or if you're a CFO, you could start updating basic emission reporting um, matrix of figures in your board pack, and what you would see is management would be interested in the climate and risk discussions. The second part is strategy. When you're reviewing business plans or budget, look for areas where climate risk or opportunities might show up. Is your supply chain exposed to floods or fires? A customer demanding greener products? A manufacturing company, for example, could start investing in eco-friendly packaging after analyzing that it could potentially open a new customer segment. Then there's risk management. Climate risk should sit alongside other business risk like interest rate inflation or cyber threats. Add extreme weather, carbon pricing, or regulatory shift to your enterprise risk register. Next, matrix and targets. Don't overcomplicate this. Start by the basics. Start gathering your electricity bill, fuel records, or water usage. That's all scope 1, scope 2 data. Once finance teams start tracking this manually in Excel and build a basic emission baseline, this is enough to inform all this, put all of this matrix in reporting and set reduction goals. And finally, this is an important tip. You don't need to be perfect. The approach is to start small, be transparent about your limitation, and improve over time. Your role in climate reporting doesn't require a sustainability title. It just needs curiosity, structure, and a willingness to connect dots between data and impact. I'll see you in the next video where we'll cover emissions, key concepts for emissions in AASB S2.